Hi, this is PR Sundar. Welcome to Mission Options. In this episode, we are going to discuss more about option buying. Why we have to buy options, what are the advantages and what are the disadvantages, and I am going to show you some live examples. Right now, the Nifty is trading around 13,000 and here I am showing you the option chain. So, here I am showing you the put option and call option, and assume that you are very bullish about the market in the month of December and you are thinking that market will be going above 13,500. So, you can see the 13,500 call option is trading around 76 rupees 50 paise. So, you are bullish. You are expecting market to go up beyond 13,500, then you are going to buy 13,500 call option which is trading around 76 rupees 50 paise. If one share is 76 rupees 50 paise, as we have discussed already, you cannot buy one share or two share. You have to buy shares in multiples of 75. That is called lot size. The Nifty lot size is 75. So, you need to buy 75 shares. So, that works out to be around 5,800 rupees. Market trading around 13,000. You are bullish. You are expecting market to go beyond 13,500 by the end of December. So, you decided to buy 13,500 call option and you have to pay roughly about 5,800 rupees. Now, by the end of December, if markets goes above 13,500, 13,600, 700, 800, so you are going to get profit. But in case market closes below 13,500 by the end of December, and whatever money you paid, that will be the loss. So, one good thing here about your maximum loss is the premium that you are paying. You are not going to lose anything more. But if you gain, if index goes to 14,000, you will get back 500 rupees. 500 into 75, you will get about 37,500 rupees. You pay only 6,000, you are going to get 36,000 if Nifty goes to 14,000. So, depending upon how much it goes, you are going to make profit. Here again, one more thing I want to tell you, it is not that today you buy the option, you have to hold the option until the end of the expiry, not necessary. If tomorrow or day after tomorrow, if the market goes slightly higher, so this premium of 76 rupees may go to 80 rupees or 85 rupees, you want to sell it, you want to come out, you can come out. So, from now until the end of December, anytime you want to come out, you can come out. You will be making some profit or some loss depending upon market is going higher or lower. Next few days, if markets move higher, you will be in profit. Next few days, market moves lower, you will be in loss. But you don't want to sell along the way, then option contract will be exercised and assigned on the day of expiry. That will be based on the closing price on the expiry day. So, the first advantage is that if market goes higher, you are going to make some profit, but if market goes lower, you are going to lose, but the loss is limited to the premium paid. But disadvantage is that the market has to go up before the expiry. Let us say market goes to 13,400, 450 like that until the end of December, then in January market shoots up, is of no use for you because your agreement is expiring on 31st of December. I am going to give you a specific example how this buying of option is useful compared to buying it in the cash market or buying it in the futures market. I am going to show you one example. I am going to take State Bank of India. So, look at State Bank of India. The price is around 245 rupees. So, State Bank of India, the price is around 245 rupees. And let us say one person wants to buy 3,000 shares in the cash market. If he wants to buy 3,000 shares in the cash market, so he has to pay 3,000 into 245. So he has to pay 7,35,000. So I am taking 3 cases. Case 1, a person want to buy cash market. He want to buy 3000 shares in State Bank of India and he is buying at 245 rupees. That means he has to pay 7,35,000 rupees from his pocket. Okay, I am assuming by the end of December, let us say the price is going to 260 rupees. By the end of December, the price is going to 260 rupees, which is about 4 to 5%. How much profit he will get, which I am going to show you here. This is the brokerage calculator. Here I have already entered the data. The delivery equity, I am buying at 245, selling at the end of December for 260 rupees. And the quantity is 3000 quantity. So, if you see the security transaction tax is 1500, exchange transaction tax, clearing charges, GST, SEBI charges, stamp duty and everything put together, the total tax and charges is working around 1684 rupees. But instead of doing it in the cash market, second person, another person, he want to buy the same thing in futures market. Is a stock futures. The price will be slightly higher, 50 paise or 1 rupee more. Here if you want to buy the same, so he has to buy one lot because one lot of State Bank of India is 3000 shares. Now let us look at the charges. And here this is in futures. Also buying at 245, selling at 260, 3000 shares. And look at the brokerage, STT, exchange transaction charges, GST, SEBI charges, stamp duty, total transaction charges. Look at the total transaction charges here is, the total transaction charges here is 1684. The total transaction charges is only 174. This is the big difference between trading in cash market and trading in futures market. Now, alternatively, instead of buying it in the cash market, instead of buying it in futures market, what I am going to do as a third alternate, I am looking at the option chain of State Bank of India. State Bank of India is trading around 245. Now, look here, I am looking at the call option. Look at the call option, and 200 call option is trading around 46 rupees 20 paise. So here the State Bank of India is trading around 245 rupees. But if you go and buy in the money call option, what is in the money I will explain later. If I buy 200 call option, I am supposed to pay 46 rupees. So anywhere market closes above 200, I am going to make profit. Assume that market closes at 260. The first guy buy for 245, closes at 260, is going to make 15 rupees profit. Future guy also buy at 245, close at 260, is also making 15 rupees profit. But in my case, 200 call option if I buy for 46 rupees, if State Bank of India closes at 260, I am also going to make 14 rupees profit. I am not going to make 15 rupees profit, I am going to make 14 rupees, 1 rupee less. So, suppose if I do this, first let us look at the charges. If I look at the charges, for the options, I am buying at 46 rupees. When the State Bank of India closes at 260, I will be selling at 60 rupees, quantity is 3000. So here my charges is 329 rupees. So if you look at the charges, if I do it in cash market is 1600, futures market is 174, options market is 329. So it is not better to do it in cash market if your investment horizon is very, very short term. You want to buy, you want to keep it for 3 years, 4 years is a different story. You want to buy with a 1 month view, it's not good to buy in cash market. You can buy it in futures market. You get the same profit, but the charges is almost 1/10. On options market, the charges are slightly higher. And now I will tell you what is a big advantage in option buying. If you are doing it in cash market, I told you, you have to pay 7,35,000 rupees from your pocket. If the same thing if you are doing in futures market. So here futures, State Bank of India, 1 lot, the total margin is about 2.5 lakhs. Cash market you pay 7.5 lakh rupees, future market you pay only 2.5 lakh rupees. So 1/3 of the money. That is such a big difference between cash market and futures market. But come to the options market. You are not going to pay any margin money. You are going to pay only the premium. What is the premium? We are buying at 46 rupees into 3000 shares. So you are going to pay only 1,38,000. And if you look at the reward, and the reward is almost 45,000 in all cases, right? Now, if somebody investing 8 lakh rupees and getting 45,000, that works out to be only 5-6% return in cash market. The same thing, somebody investing 2.5 lakh rupees in futures market and getting 45,000, his return works out to be around 20%. And the same thing, if a person buying in the cash market, options market for 1,38,000 and is getting 45,000, his return works out to be 35%. So at the end of the day, what matters is how much money you are investing and how much return you are getting. So this is a big difference for option buyer. Second thing, for one or the other reason, some crash comes into the stock market. State Bank of India from 245, it goes to 145. What will happen to the person who bought in cash market? He will lose 100 rupees per share. 3000 shares, he will lose 3 lakh rupees. What will happen to the guy who bought in future market? Also the same. But what will happen to the option market? Because he bought it for 46 rupees, he paid 1,38,000 rupees. That is the maximum loss. He is not going to lose anything more than that. And remember, there were days, certain stocks like DHFL fell 65% in one day, and Infibeam fell 70% in one day. There were stocks that fell, 40%, 50% in one day. But those days, the people who are bullish, who bought the call options, they did not lose much. But the people who played in futures and cash market, they have lost heavily. So this is the greatest advantage for option buyer. So generally, my advice is, if you are bullish and you want to go long in future, instead of going long in futures, you can buy in the money call option. The same way, if you are bearish, you are expecting the market to fall down, and you can buy in the money put option. So what is the advantage of in the money option? All those things we will discuss in the next video. Hope you enjoyed this video. Thank you for watching.